Hi everyone, I'm Mani, the CEO and founder of Valor. If you earn an income in South Carolina, you know you'll lose ordinary income taxes to federal and potentially South Carolina state taxes. But the big question is, how much will you lose? And what can you do to reduce your taxes? It's important to understand your income taxes and how they will impact your financial future, not least because that knowledge will empower you to take action to reduce your tax bill today. In this video, we'll explain what ordinary income taxes are and how they are taxed in South Carolina. We'll also show you different tax planning strategies that can significantly reduce your ordinary income taxes to help you keep more of your hard-earned money and build your wealth more efficiently. These strategies range from purchasing renewable energy projects, investing in oil and gas drilling, and leveraging charitable structures. So let's get started. What are ordinary income taxes? Ordinary income taxes refer to the taxes owed on money you earn from your usual sources, like a paycheck from your job or profits from your small business. It also includes income from things like rental properties, dividends, interest, royalties, and even some retirement accounts. Think of ordinary income as the money you earn day in and day out. Unlike other types of income, such as long-term capital gains or qualified dividends, which can receive preferential tax treatment, ordinary income gets no special tax perks and typically has a higher tax rate. The amount of income tax a person or entity pays depends on their income level. The federal income tax in most state versions are progressive, meaning the share of your income you pay in taxes increases as you earn more. However, some states levy a fixed percentage or flat income tax. In the United States, the federal income tax is levied by the U.S. government on the annual earnings of individuals, corporations, trusts, and other entities. In 2025, the federal income tax rate ranges from 10% to 37%. These tax rates are progressive, which means the rate of taxation increases as taxable income increases. Moreover, federal income taxes come with a standard deduction. For single filers, it is $15,000, and for married filing jointly, it is $30,000. Let's understand this with the help of an example. Here's Jack, who has a taxable ordinary income of $350,000. He is not married, so he is subject to the single filing standard deduction of $15,000, which brings his taxable income down to $335,000. Jack falls into the 35% tax bracket under the progressive tax system. This means the 35% bracket begins at around $250,000 of income. This is why only earnings above that threshold are taxed at 35%. While income under that amount is taxed at lower rates. Adding these amounts together, Jack would pay around $86,000 in federal income taxes for 2025, resulting in an effective tax rate of approximately 25%. What about South Carolina ordinary income taxes? Like the federal income tax, the South Carolina income tax is progressive, meaning the rate of taxation increases as taxable income increases. In 2025, there are three tax rates: 0%, 3%, and 6.2%. Moreover, South Carolina also has a standard deduction of $15,000 for single filers and $30,000 for married filing jointly. So let's say, if Jack with his $350,000 in ordinary income resides in South Carolina, he would qualify for the $15,000 standard deduction, reducing his taxable income to $335,000. Adding the amounts together, he would pay around $20,100 in South Carolina state income taxes for 2025. As you can see, income taxes are often an individual's largest annual expense, making tax planning crucial. Tax planning is a strategic approach to legally reduce your tax liability by leveraging available tax benefits and allowances. It involves making financial decisions with an understanding of their tax implications to keep more of your hard-earned money. You can also compare these different strategies based on your own situation to understand which one is the best fit for you by using our free-to-use ordinary income tax savings comparison calculator. Several tax planning strategies can help you reduce your income tax liability. Here are three of the most popular ones. First, buy a renewable energy project. Purchasing renewable energy projects can make you eligible for significant government tax incentives, such as tax credits and depreciation, to lower your income taxes. This strategy typically can return more in tax savings than your original purchase price in the first year alone, and you receive more tax savings and income in future years. This is a fit for people who have high ordinary or business income and have the time to spend over 100 plus hours in that tax year to actively run a solar business. Second, invest in an oil and gas drilling fund. This structures allow investors to put their money into the production and development of oil and gas wells. It offers substantial tax benefits, including the ability to deduct drilling costs upfront against other W-2 income, potentially recouping up to 50% of the investment in tax savings in the first year. Investors also often realize over 20% cash yields annually for the first 5 years. These investments are designed to generate significant tax savings and returns of between 1.5 and 2 times the initial investment, and most of the income and tax savings front-loaded. In addition, 15% of the income is tax-free, and you don't have any overhead beyond investing in these funds. They are a fit for high earners who want a low overhead tax savings to write off ordinary or business income. Lastly, leveraging charitable lead annuity trust or CLAT. A CLAT is a tax-advantaged structure that allows you to reduce or offset income taxes by contributing funds to the trust, which makes fixed annual payments to a charitable organization for a set period. At the end of the trust term, the remaining assets are distributed to your chosen beneficiaries, potentially with significant tax savings. This could be a fit if you meet at least 2 out of the 3 criteria. 1. If you want to write off ordinary or business. 2. Are concerned with estate taxes. Or 3. Are charitably inclined. All right, that wraps it up. Now a quick word about Valor. We've built a platform to give everyone access to the tax planning tools that billionaires such as Facebook founder Mark Zuckerberg and others use. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at valair.com, where you can read more content on the subjects, play with our online calculator, discover your potential financial gains, or schedule a call with us. Check the link in the bio for more details. Please feel free to comment, like, share, and subscribe to our channel. Thanks for watching.
Thank you.